Hi, this is Mani from bse2nse.com. So in this video, I'm going to explain for beginners of stock market as to what a stock market is and why should it exist. Why do we need the stock market? Why is it so essential for a country? Some of the basic questions and how to succeed as an investor, of course, which is what is most important for us. So in this slide I've just put up like stock market origin and purpose. uh, why does a country need the stock market? Because most times the retail investors just lose money. uh, Most of the people we just hear they just lose money. Okay, yes, there are people who make money out of it. So why is the stock market essential for a country? Why is the government persistent on functioning the stock market? So basically, the stock market helps companies raise funds. It's a place where the companies and corporate companies can come to the public to raise funds. This process is called initial public offer or IPO. So the company which is raising the fund, ideally they're expected to use the funds in a proper way to expand the business and in turn make more profits and in turn provide more employment opportunities for people in the country. So this is the ideal purpose why this opportunity is given for companies to come to the public, and the stock market serves as an interface where the companies can come and reach out to public to raise the funds. Because most likely most of the businesses when they start, the founders or the company owners, they'll infuse little of their self fund from their own pockets to start the company, but that will not be sufficient to like grow aggressively or to sustain for too long. So the other option is they go to the banks to take some debt, but that needs to be paid back, and there'll be some external investors like venture capital investors and other investors who would help in the initial stages of the company. But the public source of funds is where they raise huge amounts of money, which assuming the management is good and the company is good, it will help the company boost their sales and revenue and in turn provide more employment opportunities as well. So ideally the stock market serves as a place for companies to raise funds, and this actually boosts the economic activity in a country. So that is the purpose of the stock market. Now, of course, as an investor, you need to make sure you're investing in the right companies, because as on today, there are like over 5,000 companies that are listed, and hardly there'll be only like 100 to 200 companies which are relatively good from an investment perspective, which are trustworthy of investing our hard-earned money. So most likely our education system does not include any information. So when an investor is blindly coming into the stock market, investing based on news, and randomly if you pick out of 5,000, you will most likely invest in a bad company and end up losing money. So the next slide here, I'm just depicting again like a business or a company. They come to the IPO market, they raise funds from the public, and after that the shares are given to the investors, and then it goes to the secondary market or what is called as the stock market, wherein the shares get traded and just exchanges hand, just like people buy and sell properties. Here in the Indian stock market or the secondary market, they just buy and sell shares from each other, and it keeps changing hands. So in this slide, I'm just putting up some of the basic fundamental analysis that people should know, and some of the analysis are pretty simple. Just like a individual, a company will also have debt or what is known as loans. They'll take loans from the banks, and a company with high amount of debts will always struggle to move forward, and the investors who are invested in the company also struggle, or the share price typically goes down. I forgot to mention one more point here. So like promoter pledged shares. So that is what is called as debt analysis. Ideally, from an investor perspective, invest in companies with zero debt or very little debt, because if a company has too much amount of debt, it's a risk for the company that when the sales or revenues goes down, their profits will get hit a lot, and it can also run into losses at times, and that can actually push the share price very low. And typically when the share market falls a lot or a correction happens, companies with too much of debt will actually go down a lot than companies with zero debt. The next is brand value analysis. Like investing, there are like I said, there are like over 5,000 companies that are listed, and it is relatively better to invest in companies that you know. For example, HUL, Hindustan Unilever, ITC. ITC, you know that we would be using biscuits, Sunfeast biscuits. HUL is nothing but Hindustan Unilever. We're using many products. There are companies like Horlicks, GlaxoSmithKline Consumer Healthcare, Colgate. There are many known companies like TTK Prestige pressure cooker. So even though most people only talk about Infosys as a successful company which has given good returns, there are many companies which have given 10 times returns, 20 times returns, 100 times returns, companies that we know ourselves. For example, Fevicol, Pidilite Industries. So these are companies that we know. So ideally, companies with very high brand value will relatively be beneficial for the investor, and they will mostly give good returns and profitable returns to the investor. The third analysis is revenue or profit growth analysis. You can again check how a company has done in the last 5 years, how consistent they are in their revenues, and how consistently they've grown in their revenues. And the other perspective that you can look at is the competition. Now, for example, the only competitive product for Horlicks in India is Complan, and Complan is actually owned by HUL, Hindustan Unilever. So as such, there's not too many competition for Horlicks. So when you are investing in GlaxoSmithKline Consumer Healthcare, which is nothing but Horlicks is one of their products, so you know that the only competition is HUL. So you know that when the growth is there, they will grow consistently better than compared to, for example, in the cement industry, there are like 20 companies. So each company is competing with each other. So there are more number of competitors. So profit growth will always be that much more difficult to come. The last point I've put up here is there are many companies with promoter stake which is pledged. So that actually is a very huge negative for the company. For example, companies like Suzlon, Unitech, HTIL, these kind of companies, the shares always goes down a lot. So watch out for that. Just make sure you invest in safe companies. If you look at these 5 categories and you filter down the companies, out of 6,000 companies, you can filter down to only 100 worthy companies, and I would actually be picking only like 50 of them to really be looking to invest my hard-earned money. So make sure before you start with your investments or long-term investments, make sure you're picking the right companies. Do not invest blindly. So that can always be a difficult situation. Once you make the wrong decisions, it's very difficult. So just to talk about again, why should we take such huge risks to actually be investing our hard-earned money? Or one could just simply invest in gold. This is the chart of gold. Even gold has historically given decent amount of returns. I think a return that is better than fixed deposit. So just again, what's the big deal? Why should we actually invest in stock markets? So here's assuming I am investing 1 lakh today, here's the fixed deposit returns. Stock market returns, assuming you're picking the right companies. So 20% stock market investments if it is 30%, if you're able to achieve 30% every year. And if you invest 1 lakh today, 20 years down the lane, the fixed deposit will end up with 6.7 lakhs. But stock market with 20% returns will be 38 lakhs. Stock market with 30% returns will be close to 2 crores. So this is what happens if you invest safely and properly, pick the right companies, and do the right kind of investment. So this is how much you can leverage from the stock market. Again, you need not invest blindly or completely in stock market alone. Make investments in gold, make investments in fixed deposit as well. But try to also pick good companies and invest in stock market, and look to invest for long term, something like at least 10 years or 20 years time frame. You should definitely do well. I think this video is decent enough for a stock market beginner. Now, some of the fundamental analysis that I just mentioned in the previous slide, most of this I've explained in my book. To read my book, the book doesn't cost too much. I've put up all the details in the book. The book costs 300 rupees. You can log on to bse2nse.com and order for the book for cash on delivery. So once you know these few basic rules and you know how to pick the right companies, then it becomes very easy to invest long term, and stock market is not actually complicated. But unfortunately, we are not taught about this in our school education, and most people, when they start out, 99% of the people start out with pretty much zero knowledge, and instead of learning the basics and getting the basics right, they invest based on the news and what they hear, invest on rumors, invest on what someone else is telling, and they end up going wrong mostly. So just to sign off before this video goes, I just want to share something about Warren Buffett. He's been an investor since 1965, and in the 40-year period between 1965 to 2005, he was able to achieve 21% returns, and he's a great inspiration for anyone who is looking to invest in stock market. So any questions or any queries, as usual, feel free to post in this video, and subscribe to our YouTube channel for more videos. We are also there in Facebook. Log on to bse2nse.com and you can register and post any queries of yours as well. So that's it for now. Thank you.